Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of New York and London coffee markets. I'll start with New York coffee. The conversion, at least for the time being, of the November 2021 to May 2022 head and shoulders top to a head and shoulders continuation pattern, whilst it has been the main event for this year, it is on the cusp of leading to another much larger pattern, one that I will deal with in a little while. So, early June saw the market reach up to the 2012 high at 241.05, creating an unsuccessful, smaller reverse head and shoulders pattern for the mid-April to end of May action. I will retire the primary target X in the 248.20 area and the secondary target X1 in the 256.15 area for these after the commentary. We've seen since that height in June so many contrary and conflicting patterns here, but we have settled into a seeming 2 steps down and 1 step up action, such that today we saw prices pierce the April 21 to date uptrend, currently at 214.05. Now, this uptrend on its own is not that special. It is what it represents in the bigger picture that we should be looking at, and it is here that I bring in my comments earlier of a bigger pattern, a possible diamond pattern, where this uptrend makes up the lower uptrend trend line. This is early yet on in this pattern, as it could easily be a false break on the downside, but the move lower is still there, and it now needs confirmation, which we would need to see in the next few days. In the meantime, we also have another more localized pattern triggered. I mentioned this a few times now, but we have a possible lopsided cat's ears pattern over late May to date. I was, and even now still am, not altogether happy with this pattern, which is a derivation of a double top pattern, as the right ear is significantly lower than the left, and we all have what appears to be a third ear as well. But elements of this pattern still do exist. Hence, I had placed last time a potential primary target X2 for this cat's ears pattern in the 201 even area, as well as a secondary target X3 in the 196 area. I would add a heavy dose of it all depends. It all depends on whether the action from mid-November last year until this time is a possible huge lopsided diamond pattern. Now, before I finish here, I would add a further pattern that has just finished its possible construction last week. I say possible a lot here, but it's true. This is a possible bow tie formation of the 3 moving averages: the declining short moving average, currently 225.05, the declining medium moving average, currently 225.5, and the slowly rising long moving average, currently 225.85. It's not a perfect crossover of moving averages, whenever is it, but it is still there. Now, in both bow tie formations, there are 2 expectations. The first is that between 15 and 20 sessions after the crossover, we would see a move in the direction of the bow tie. This would be between the 29th of July and the 5th of August. Secondly, that the market will move in the direction of the second bow, that is in the one after the crossover. Right now, that looks like a bearish crossover of moving averages. It's not a done deal as yet, but I thought you ought to be made aware of this. London coffee. As I keep saying here each week, mainly because it still resonates to this very day, is that the key difference seen here in London compared to the New York contract is how the peak of the market was back in late December 2021, rather than when New York had it, which was in early February 2022. This difference has been crucial to the formation of a pattern here in the London contract, much earlier compared to the New York contract. We had a November 2021 to February 2022 head and shoulders top. Now, admittedly, and that's a top, that's a proper top, admittedly, the first shoulder is split, but the action nevertheless stacks up as a legitimate pattern. The neckline, currently 21.07, is super important, as it resonates as recently as 3 weeks ago, when prices moved up to touch it and almost immediately backed off lower. Going back a bit to March, the market broke down through the neckline but ended up unable to penetrate the support area underneath. And that stretches from the 2004 level all the way down to the 1935 area. In early May, prices made a significant attempt lower, making a new low, not seen since August 2021. Yet that achievement was with a pinch of salt, as it was only a little lower compared to the low in early March. Nevertheless, it was worth noting that the primary target for this head and shoulders top had been achieved some while ago, and there was a secondary target that was unabled, and as I've often pointed out, secondary targets are harder to achieve. The key takeaway from this was not that it had achieved the primary target below, though that was important. It was that this head and shoulders pattern was a topping action, completely different to what we are seeing in the New York contract. Now, since that failed attempt lower back in early May, we've seen the market start to develop not only intraday indecision, such as spinning tops, but also intraday indecision, with contrary patterns, one after another. This indecision overall worked the market lower, such that at the end of June, prices had reached the key 2004 level and started tackling it, and the other supports, initially all the way down to the 1968 area. Last week, prices accelerated a decline, but on the last day of last week, they made a large combined key reversal up and bullish engulfing pattern, with the low reaching 1937 and just short of that 1935 area of this recent congestion band. The question now is whether the market will turn back up, or is it just a temporary setback before prices turn back again. Right now it's looking like a temporary setback, and we may well see prices testing lower still. This brings me to the large pattern I have been commenting upon now for weeks. It's a large rectangle pattern from the start of March until the end of June. Well, I call it a rectangle, but it is moving to be more like a shallow descending wedge pattern. But for now, rectangle will do. That's currently roughly between 20,000 and 2142. Now, the primary target for this pattern as a rectangle on the downside is in the 1923 area. For secondary, harder to achieve, target X1 in the 1858 area. Let's see if these are achieved. Target X is not that big an ask. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyrights Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.